Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. I'm Michael Avery, and this week we lift the regulatory hood of the South African stablecoin market. Stablecoins, South Africa's Intergovernmental Fintech Working Group, the IFWG discussion paper on rand-pegged stablecoins, has implications for M&A activity in the fintech, payments and financial services sectors. Regulators appear to be moving rand-pegged stablecoins out of the crypto Wild West and into the realm of regulated financial infrastructure. And that could have major consequences, not just for payments and fintech, but for deal making. If stablecoins are here to stay, banks and fintechs, custodians and global players may soon be asking, do we build, buy, partner, or risk being disintermediated in this move into the future of the way we exchange value? Well, to unpack this, I'm joined by Ashlin Perumall, who's a partner in Baker McKenzie's corporate M&A and IPTech practice groups in Johannesburg. Ashlin, I must say, great to have you on. When we say rand-pegged stablecoin, legally, what are we actually talking about? Is it a crypto asset? Is it an e-money instrument? Is it a deposit-like product? Is it a payment? Is it a claim on reserves? What is it?
Thanks so much, Michael, and it's a pleasure to be here today. That's actually a great question, and it's sort of a pointed one that is showing why this class of asset is requiring its own unique attention by the regulators. So stablecoins, briefly for the listeners, is a type of crypto asset, but it's designed to maintain some sort of stable value relative to a specific external reference. So that reference could be an external asset, a pool of assets, or a basket of assets, whatever that may be. And the way it functions is different in an economy from how ordinary crypto assets function. So whereas crypto assets provide some level of opportunity for investment, speculative investment or the like, stablecoins, because they are typically designed to be pegged to a particular currency value, they have started to form part of financial infrastructure. So for example, remittance payments or decentralized finance or DeFi arrangements. The core concept being that by maintaining or allegedly maintaining some sort of stable value, they're able to facilitate payments, they're able to act as the backbone for movements of money and the like. Now, that's important because of how the regulators have had to look at it. To date, obviously, our regulators have focused much more on crypto assets and the typical kind of crypto assets that you experience like Bitcoin and the like. Because the stablecoin environment is different, because they mimic traditional money and can scale rapidly. They involve traditional financial institutions and banks and other specific regulatory nuances that are different. They're requiring a different approach and attention from the regulator.
Now, talk to me. I think that's a great description and explanation of what we're talking about when we're dealing with these stable coins and why they differ so much from traditional crypto assets like cryptocurrencies. And why does this IFWG discussion paper matter? Is it just another crypto policy document, or does it mark a genuine shift in how the regulator is approaching and seeing stable coins and their role in the market?
It absolutely matters, and I'll mention why. So the stablecoin market at the moment is absolutely growing. Globally, we're seeing numbers like $33 billion US dollars in transactions a day, and the speed of these payments are incredibly fast, faster than some of the card schemes. And what that means is that in terms of regulating and ensuring that they're safely deployed, that's come to the attention of the regulators. Now, this policy paper is positioned in exactly that space. It's actually a two-part paper. The first one was published last year, and that was a diagnostic paper. It was looking at assessing what was the stablecoin market in South Africa, and specifically ZAR-backed, so rand-backed stablecoins, not the dollar-backed or other currency-backed stablecoins that we tend to see. The second paper, the one that was published in March this year, that one's more focused on the macroeconomic risks. So drawing from last year's papers, unpacking what those risks are, and putting forward some of the regulators' thinking on how they'd go about regulating this. Now, all of this was structured around the original papers, structured around bringing crypto assets under the AML and conduct perimeter, so the FSCA conduct perimeter. which is how we've regulated crypto assets in South Africa to date. And that's important. It means that what we've done in South Africa is we've regulated downstream. We've regulated essentially secondary market activities, or we've regulated the activities that surround crypto assets, for example, services, intermediary services, and the like. We don't actually have a regime that regulates the issue of crypto assets. So in other words, the primary market activities and regulation of the actual issuers. And that's important because there are, as this infrastructure starts to scale, there are questions that need to be asked as to what unique risks could an issuer create in respect of deploying these mechanisms into a market, and what are the gaps that are created by that. Now, what the regulator's done in this paper, which I think is quite different and it's not something that they would usually do, is it's the first time a South African regulator has sat down and asked in a public document, where would a stablecoin actually live in our financial services infrastructure? Is it e-money? Is it a collective investment scheme? Is it deposit taking or quasi-bank activity? The March paper runs this matrix, I think, quite honestly, and it concludes that none of those frames quite fit. Now, what this means, and this is quite important to the market, is that stablecoins are being taken seriously. They're unlikely to be banned. So the paper specifically rules out a ban, so that gives us some confidence in terms of the future. And it rules out muddling through existing regimes, so trying to apply existing law and stretching it to fit. I think the paper implicitly, if not explicitly, notes that the current regimes are not adept and they're not quite well fit to stablecoins. And that leaves one direction of travel, I think, a bespoke risk-based regime, perhaps something that is bolted onto the Kofi Bill or the FSR Act. So, in that regard, I think it gives anybody building or buying in this space a lot of confidence that it's not going to be banned. It's probably not going to be a exact application of a current regime, and it's going to be something that's new and targeted towards stablecoins specifically. And I think that's not just a policy paper or a policy document on that basis. It's actually the first chapter of a new regulatory perimeter.
And that's the interesting question here, because if one looks at where the real regulatory perimeter is, from what I'm hearing you saying, your interpretation of the policy document is that it will be risk-based and looking at where the key legal trigger might then determine under which regulatory regime it sits, whether it's the issuance of the token or the acceptance of fiat or the promise of redemption or just the facilitation of payments, maybe even just the client funds that are under your control. Very, very interesting that. If you look at it, though, just from the outside, and forgive me as a kind of layperson here, but stablecoins, I think, sit uncomfortably close to traditional banking functions because they accept value, they enable payments, they offer redemption. At what point does a stablecoin issuer start looking bank-like in the eyes of regulators?
That's such an interesting question. And I think from a lawyer's perspective, the most legally interesting section of the paper, the IFWG works, and they describe this in the paper, they work through the application of the Banks Act and the definition of deposit. And I think they conclude quite candidly, to put it that way, that taking fiat in exchange for a redeemable token, it does fall into that territory. Money received, equal amount repayable on demand, with or without interest. I mean, that is textbook deposit taking. Where the issuer's business model diverges, and I think this is not just South Africa that's picking this up, this is global observation from a traditional bank, is on the asset side. A stablecoin issuer should be holding reserves to maintain the peg, not on lending those proceeds to generate some kind of a yield. But the moment you start investing reserves to generate yield, which is how most stablecoins globally might make money, you're doing maturity transformation. You're doing investment and you're getting closer and closer to the bank perimeter. Now, the honest answer is the line between these two environments, deposit or not deposit, I think it's being held together by the drafting of the regulations globally, rather more than economic substance. Now, we've seen this with the Genius Act in the USA. There was a lot of discussion about yield and whether there should be the ability of generating yield on the basis of the treasury-backed assets. My honest answer is I think that the line is being held and will be held in South Africa on this basis. I don't think there's going to be the ability to invest and generate any sort of yield on the basis of the backed assets. And that's what would take this, I think, clearly out of deposit taking and pure bank activity. This prevents stablecoins from being economically equivalent to bank deposits, which I think is the core risk in respecting of that overlay.
I want to zoom out a bit. Thanks for that observation, Ashlin. The signal here is obviously, as you mentioned, it's not going to be banned. It's not going to be prohibited. It's going to be regulated probably on a risk basis. And that seems significant for the future. As you said, the first chapter, how significant do you see it in terms of institutional investors and banks and payment players who may previously have viewed stablecoins as too risky? Are we likely to see an uptick in M&A in this space as a result of this evolution?
I think so. I think that the core difference here and where we would perhaps see some M&A activity is if we think about what's actually scarce at the moment. Code is not scarce. Open source stablecoin protocols exist. Reserve assets are not scarce. Anyone with capital can buy government bonds. Users can be acquired within the marketing budget. It's generally hard to use those as a basis to see that there'll be any sort of change in the M&A activity. What is genuinely hard to replicate is regulatory credibility and bank-grade institutional relationships. And so I think this is where we do see a focus and a shift if we do start to see regulations in South Africa. Acquirers are typically paying for, in what I would say priority order, license pathway and regulatory engagement track record, banking relationships, particularly for reserve custody and fiat on-ramps or off-ramps, the compliance architecture and muscle and AML program. These are the things that take years, not months, to build. And as the demand for that in any sort of fintech space starts to grow, that's kind of where the M&A focus starts to shift. What's your muscle and ability to actually provide access to a market based on that? So, from that perspective, I think that there's a lot of opportunity that's going to be created by some sort of certainty being provided by the regulators in this space.
And the ecosystem is currently very fragmented, from issuance to custody to reserve management to technology. Do you think that with the regulation coupled together might tend to force consolidation in a market like this?
I think so. When it comes to the consolidation and where we might start seeing a lot more focus is there aren't many organizations that can structure this well. I mean, if you look at the ecosystem at the moment, you're going to need to have exchange relationships. You're going to have to need either bank relationships or financial institution relationships on the backing side. You're going to have distribution channels for whatever the stablecoin is, and use case channels if it's payments, if it's crypto, DeFi, whatever it may be. There are not that many players in the South African ecosystem that can do that. And so I think that we may start to see a greater focus and a refocus of what we can currently see as a fragmented market. Contrary to that, and what I think is worth taking into account is regulators don't like too much fragmentation where there are critical financial infrastructure assets. It's difficult to coordinate all of the risks, AML risks, financial stability risks, etc., across a very diverse stack of players. So I think that maybe even be forced by the regulators' demands from a compliance perspective, where there is so much to comply with. Managing that off of a fragmented horizontal stack of players is going to be difficult. So we're probably going to see a lot more vertical integration, where you start to see one organization, whether it be a bank or some sort of a tech player, bringing these a lot more in-house and together. But I don't think you're going to see the situation where you don't still have to engage with some of the incumbents, either on the crypto asset exchange side or the bank side, because there just aren't that many players. I mean, if you look at the issuer side, there's only about 5 serious ZAR issuers at the moment. So some consolidation definitely to try and address the fragmentation risk on compliance. But I think there's still going to need to be some level of cross players to enable the market because it's just so small at the moment.
Yeah, and also in order to enable those use cases and extract value, one could probably expect vertical integration with one compliant platform controlling a full value chain. That could become the winning model here. If you were to say what future market looks like and who the likely buyers are, would you say most probably banks or payments processors that are trying to defend their payment rails? Would you say again that the incumbents are probably best positioned in the South African market?
I mean, right now, I think it's incumbents and adjacents. So banks, listed payments groups, listed insurers and asset managers, mostly moving defensively. They have the capital, they have the existing licenses and the franchise risk. And I think that's what we may start to see. And we're already starting to see that. Maybe a year and a half out, I think infrastructure, private equity and pension adjacent capital Once the bespoke frameworks are closer to settled, they would want regulated, predictable infrastructure like cash flows, and they cannot underwrite regulatory uncertainty. So I think they're a little bit far out in terms of immediate activity. 24 months out, so looking at 2028 and beyond, the global crypto native exchanges start to come into play. I think global fintechs and large international players, payments groups looking for an African foothold, that's when they, I think, will start looking at this, because at that point in time, we probably will have regulation, and regulation with some sort of timeline after it, so that we can see how it plays out and how institutions organize themselves around that. Now, they would normally be slower to enter markets because they're choosing right now jurisdictionally. They're choosing between South Africa, Nigeria, Kenya, and perhaps the Gulf. South Africa only wins in that competition if our framework lands pretty well. So in other words, if it's certain, if it gives some level of credibility to the South African ecosystem, if it's playable in terms of what it would take an organization to get compliant. I think that the wild card in terms of investors would be your sovereign and quasi-sovereign capital, your DFIs, central bank adjacent vehicles, which have historically been quiet in the space. They're starting to pay attention, but I think for me, I'm not sure that anytime soon you're going to start seeing likely buyers in that space as well.
I just want to come back to how investors and users, and I guess to some extent issuers, ensure that they are protected in an environment where we have, and I know there's lots of concentration, and we look at the markets globally. Tether is the big player. I think somewhere 90% of the market that they control. But we saw back in, I think 2021, 2022, Terra USD collapse, and it lost its peg. I think it wiped out, it must have been around $40 billion in market value. So bring that back to the ZAR stablecoin environment. If a Rand stablecoin is backed one for one by cash or near cash instruments, call it, who legally owns the reserve assets? Is it the issuer? Is it the token holder? Is it a trust? Is it somewhere else? Because that reserve structure feels central. And what would a robust legal architecture look like to ensure that there's confidence? Remote SPVs or independent custodians, or maybe a regulator looking at daily audited settlement amounts. I just want to get an idea as to where you see that direction of travel heading.
A great question. I mean, that's really the fundamental question of what is stable in the stablecoin? Where's the money?
Yeah.
Who control? Can users redeem? I mean, essentially, Michael, I think the question sits quite comfortably under the custody answer. So which bank, which jurisdiction, which account, is it segregated or commingled, and is that obligatory, and in whose name? Now, the IFWG paper is fairly clear that reserves should be held at regulated financial institutions and should be auditable. The structure that we're currently seeing right now is banks as bankers, government bonds and bank deposits as the reserve and assets, all offshore. And that's essentially the template that I think many others are going to follow. Who controls it? Now that goes to your legal claim question. Are the reserves bankruptcy remote in respect to the issuer? Do stablecoins holders have a direct legal claim or contractual claim against the issuer that goes straight into the creditor pool on insolvency? In most of the global arrangements, the answer is the latter. And I think the IFWG paper expressly identifies this as a problem that requires a bespoke regulatory fix. And I think that the answer there is really going to be that you need to have onshore regulated institution providing that backing. It needs to be audited. There probably needs to also be some level of informational disclosure, and that there needs to be a structure as to what backing means. So, standardized definitions on backing, and specifically standardized definitions on liquidity and mechanism questions. So what I mean by that latter part is that whilst we may talk about a financial institution being the backer, the governance is important. In other words, how is this going to be governed within the institution? Who has control of the assets? What are the operational hours of those individuals? What's the contractual SLA? There's a lot of work that needs to be done, both in terms of clarifying what backing means and what would meet the standard for South Africa. And I think for me, that's institutional grade, and that's something that will be pushed. There's a lot that needs to be done on disclosure. So what kind of informational disclosure is there that can ensure that individuals who use this are no information asymmetry in terms of risks? And lastly, I think it's really important to nail down that governance question. It's probably been the hardest question globally to get regulated, and that is to create some sort of standard around governance around those backed assets. those are the kind of questions that I think are going to emerge. And I think the global approach that we're seeing in Europe and perhaps the USA are where we may start drawing from in terms of best practices.
Yeah, and we've got the EU's markets in crypto assets regulation, MiCA, fully implemented as well, and that creates very strict standards, including prohibiting interest payments on stablecoin holdings. I think it's a key differentiator from the US rules that you mentioned earlier. But on that matter, it's so important because, if the issuer fails, token holders will want to know whether they've got proprietary claim to the reserves or they're unsecured creditors. And for me, I think a lot of the M&A value will ultimately sit not necessarily in the token technology, I think that's fairly ubiquitous, but in the enforceability of the reserve and the redemption and the custody arrangements.
No, absolutely. And I couldn't agree with that statement more. I think that, especially in terms of the institutional users, they're going to, I think, require that as a must. I unfortunately think that your average user, so your retail users, so for example, someone is using this for a remittance, you probably heard of the stablecoin sandwich examples where you have fiat on-ramps in South Africa that go through stablecoin rails and outpay to another country such as Naira in Nigeria. Yeah. The concept there is that, or the problem there is that most of the users who are using the platform, so use stablecoins for those kind of payments, they don't really understand any of this. They're not going to understand the difference between a USDC or a US dollar. They're not going to understand these sort of mechanics that go behind payments and payment rails. So there, I think that one aspect that should be focused on, if we're going to start saying that stablecoins enable financial inclusion, is financial education. I think that, users need to understand the difference between these technologies and how a stablecoin is different from a bank deposit or an ordinary SWIFT payment, or regulators are going to have to create the same levels of controls that mimic the current incumbents. And I don't think that latter approach makes a lot of sense at scale. So I think that one part of this to enhance particularly the financial inclusion benefit that's touted is to really, bolster and ensure that there's more financial education, there's more disclaimers and disclosures that are given to the average consumer as well.
And then to bring it out maybe to the regulatory level, we've just got off the FATF grey list. I would imagine that there's got to be a lot of work done around anti-money laundering. And, often proponents say, well, stable coins are good because they're programmable, they're traceable, but they're also portable and potentially carry pseudonyms. And I suppose that creates another kind of challenge around what a credible AML or KYC architecture would need to include. How is this addressed in the paper?
So when it comes to the broader risks and the risks that surround what you're speaking of, I think that the way in which the paper addresses the AML risks is to re-anchor this in what was already done in the first paper in 2021 around the crypto assets environment. And that is that there's certain controls that have been put in place in respect of crypto assets already, including the travel rule, which I think has created a lot of unfortunate burdens for the businesses who operate in the space, but at the same time has really, really helped to solve some of the, not all, but some of the problems in the crypto asset space. I think where that gets solved to some degree in the stablecoin space is in just deciding what kind of stablecoin architecture we're willing to accept. And what I mean by that is stablecoin architectures that operate really independently in their own DLT environments and can essentially be traded wallet to wallet with no sort of intermediary or permissioned environments. Those are going to become, I think, the more risky assets. So the ones that are permissionless environments, you can essentially use those stablecoins or trade them individual to individual or peer to peer. We might see a greater, I think, focus on permissioned environments. So where you actually can only move those assets through in permissioned environments. So through a financial institution, exchange, payments provider, the like. And that may be one control that is being thought of. Now, I know there's going to be a lot of pushback, and that's quite a controversial thing to say amongst the players who do participate in this market. But I think that from an AML perspective, we are going to have to choose architectures that make more clarified sense, especially if these are backed by actual ZARs and actual accounts. The relevant bank institutions providing that backing, I think, won't be able to absorb that risk unless these are permissioned environments in the short term.
It's always about striking a balance when it comes to regulation on these things, because South Africa is being positioned as a possible launchpad for African payments networks. And for global fintechs, one might question whether we are attractive because of our regulatory credibility, or maybe unattractive because compliance is now relatively sophisticated and demanding. Where would you say we're kind of sitting or positioning ourselves in that broader conversation?
So on that question, I mean, South Africa does have some structural advantages. We have active membership in the FSB, IOSCO, FATF, the BIS. And by that, I mean we're part of the international rule setting process. We're not just at the receiving end of it. Now, deep capital markets and listed banks with, for example, cross-border presence, there's a multitude of them in South Africa already. There's also dual qualified legal infrastructure that can structure complex arrangements credibly, both in common law as well as for civil law counterparts. So I think that, at that level, we have some structural advantages that I think many other countries in Africa or abroad don't have. But I think you're touching on the fragmentation risk. I think the fragmentation is real. Each African jurisdiction in the continent is at a different stage. Nigeria is going the CBDC route, and they have restrictive controls on private stablecoins. Kenya is taking the sandbox approach. Mauritius is positioning as an offshore hub. We really don't have the equivalent of a over-encompassing continent-wide MICA that is going to create any sort of stability and commonality. And I don't think that's going to happen anytime soon. The other constraint is obviously South African exchange control, which is in the crypto space been a huge area of controversy and difficulty if you're a player in the space.
Yeah.
SARB still governs cross-border RAN movements, and stablecoins that purport to enable 24/7 cross-border RAN settlements run straight into that framework. Whatever the IFWG produces will need to be sequenced with an updated exchange control posture, I think. Otherwise, the cross-border use case and all the consortium platforms that are building around that, they'll never quite work unless we get clarity on how are we going to evolve the exchange control and FinServ environment to suit these kinds of products. And probably going to jump out for many foreign investors and buyers and others in the space as one of the unique characteristics that's holding us back in South Africa.
No, I still think we're having this conversation about a very future-facing technology and the evolution of payments and financial services and value exchange. And at the same time, we live with a very anachronistic exchange control framework, which I think harks back to a bygone era and hasn't really kept up to speed with South Africa. And we can go down a rabbit hole and the impact it's having on our venture capital and high scale-up startup sector as well. But just lastly, with everything we've unpacked, let's just finish on an issue around deal structure. And if you're an investor, the final regulatory framework isn't yet quite settled. We can see the direction of travel. How do you protect yourself broadly? Are you seeing things like minority stakes or JVs or options and earnouts likely to become the preferred way to enter the space without taking full regulatory risk up front?
So I think in South Africa, obviously, this is relatively new. Not so new if you're in the space, but relatively new. But globally, this is actually well-trodden M&A territory. We've done this every time a market has moved from unregulated to regulated. So the toolkit is kind of mature. Conditions precedent tied to specific regulatory milestones will be important. Things like license application accepted, no objection letters from SARB, specific PA or FSCA outcomes, those kind of things. Building some level of mapping to the trajectory of the regulatory environment into your deals whilst not waiting for the environment to become settled, because by that time the deals have already happened. And next to that, robust regulatory representations and warranties are important, and making sure that whoever your lawyer is doing the deal understand this environment and can structure those correctly, with materiality scrapes carved out for stablecoin specific risk. Now, regulatory MAC clauses, giving the buyer a walk-away right essentially if the framework lands materially adverse to the business model, is something I would push if you're on the buyer side. It's going to be difficult to negotiate, but that's something I would push, as well as reverse termination fees if a buyer walks as the corollary to that. And specific indemnities for legacy, reserve, composition, or pre-closing redemption events. And to the extent it's possible, escrows for regulatory exposures, although that would be pretty rare to deploy here. I mean, beyond the contract, though, deal structure, phased acquisitions with clear gates, earnouts tied to regulatory milestones rather than just commercial performance, convertible instruments rather than equity in the first instance. Each of these I think is a way to keep the optionality open whilst the market is still locking in the commercial position. Now, I'm saying all of those things as examples. All of us know that in negotiated deals in a space that is rapidly evolving, you need to find yourself relationship partners who are embedded, they understand the environment, they're trustworthy in terms of being able to navigate it nimbly. That for me is going to be more important, really finding and building on those trusted relationships. And there's many toolkit approaches we can take in the contracting for the deal, in the diligence approach, in the CPs, etc., to protect you. But in this environment, a lot more actually sits on finding the right partners and making sure that those partners are on for the journey. I think that's where I would say there's going to be a lot more impact. One last thing on that front is I think we're starting to see the consortium approach work. There's a few of the incumbents in the financial institution space, in the bank space, who are kind of seeing this as something that may impact their franchise of deposit taking money and asset provision and money lending. And I think in that space, we're seeing consortiums and building these right partnerships as the core structure being a feature. Right now, from a regulatory perspective, we don't have a recognized structure for these partnerships or consortiums. So, in South Africa right now, an individual could even issue a stablecoin. That's just absolutely open at the moment. And I think in that lies in some risks. People might create exotic structures and things that might not fit in with the direction of travel globally. For that, I think the larger players who focused on structure, what they've done is they've gone and mimicked what's been done in the heavily regulated market. So mimicking what we have done in the MICA environment or in the US or even the UK, and understanding that I think has a lot more long-term credibility to it. Using SPVs in respect of backed assets as an example. I think that would be my approach on the structure side. So strong contracts in focusing on partnerships and increasing assessment of what's being done globally and what's sort of settling normatively would be my recommendation in a market shifting as fast as this.
And it really is a fascinating time to be in this space, in this market, because it's not really a crypto story, as we've heard. It's a story about ultimately who gets to issue and hold and move and monetize the future of the rand, the digital czar. I mean, currency is digital anyway, but as we see with stablecoins, it is growing at a rapid rate. And all over the world, I think regulators are trying to keep up. And it's great to see that our regulators are thinking so deeply about this. Ashlin Perumall, thank you very much. Partner in Baker McKenzie's corporate M&A IPTech practice group in Johannesburg, talking about South Africa's Intergovernmental FinTech Working Group discussion paper on rand-pegged stablecoins, which clearly has deep implications for M&A activity in the FinTech, payment and financial services sectors. That's all for this week. Be sure to like and subscribe and join us next week for more insights on the Monocle Banking Podcast.